Give us your thoughts on where inflation is. Do you think we've peaked on the inflation story then, or could it still go higher from here?
Well, I wouldn't be surprised if inflation wobbles around a bit. We've seen that over the course of the last year or so. Easter's a bit early. That may have brought forward some price increases into March that would otherwise take place in April. And I think the fall back in inflation that we're starting to see will be quite gradual. So it's not going to be dramatic, but it will gradually ease some of the squeeze that consumers have been feeling.
And this is a really good chart to paint the picture of that squeeze. 5339 on the Bloomberg, Andrew, and it shows in the white the UK inflation rate and the fact that it's, you know, it looks to have peaked and is coming down. Whether it goes up, though, again, wobbles around a bit from here, we'll see. And then the UK basic wage growth, 3-month average we've got here in blue. So this shows very nicely the way that inflation has been higher than wages, but that does seem to be correcting. Is it the direction of those two lines that gives the Bank of England the comfort that it can raise interest rates, do you think?
Well, I think there's two reasons, well, probably three reasons, actually, why the Bank of England might raise interest rates. One is there's a longer-term requirement, really, to try and get interest rates up from these rock-bottom levels. When I was on the MPC and we cut interest rates to 0.5%, I didn't think we would be sitting here 9 years later not having really significantly raised them. Secondly, the world economy is quite strong, and that's providing quite a bit of a lift for the UK economy. And thirdly, as you say, this consumer squeeze is starting to ease. And we should see perhaps wage growth slightly above inflation, perhaps in the second half of this year. But we're not going back to the very strong consumer spending growth that we saw from 2014 to 2016.
Andrew, good morning to you. From a global perspective, and you've sat on the MPC, and I want to try and understand what might be happening in the psyche of the central bank at the moment. We have the edifice of the equity market crumbling. Technology stocks are very in focus. There's a potential for a trade war. We now have tariffs between the United States and China. Give me a sense of that kind of hubris and what that does to the conversation within the MPC.
Well, I think you can always find a reason for not raising interest rates, and we've seen a lot of that from the Bank of England over the last 4 or 5 years. In fact, looking back, 2014 looked a quite good time to have raised interest rates, but they put it off then, they put it off in subsequent years. And yes, there's always going to be some worries, and you mentioned what's going on the trade front. But actually, if we look at the global economy as a whole, the global economy is really quite strong at the moment. We've got all the three main engines of the global economy, Europe, North America and Asia, growing quite reasonably well in their own terms. And so I think there's always going to be a little bit of nervousness around. But the more important issue is that strategically central banks do need to move interest rates up from emergency levels. And we've seen that done relatively successfully in the US, and it hasn't hampered growth. And I'm not sure it's going to hamper growth if it's done gradually over here as well.
This is going to be the first year, by the way, that net money into the global markets from central banks is set to turn negative, Andrew. Are we in much better shape to handle the return to a new normal? Where is the new normal for Andrew Sentance in terms of the terminal rate, Andrew? What can we handle?
Well, we can only look perhaps 2 to 3 years ahead. But I think central banks in the US and the UK should be thinking of getting rates up to somewhere between 2 and 3%, perhaps just over 2%, and then taking stock. Now, the US is actually very well down that path already, and it won't possibly, over the course of this year, they'll get rates up over 2%. Then at least the interest rate is covering the rate of inflation, assuming that it's round about the target of 2%. I think the worry I have about the Bank of England is that they've shown a lot of nervousness about embarking on that course. And I think that nervousness then translates into the financial markets, who start being nervous as well.